Welcome to Thoughts on the Market. I'm Matthew Hornbach, Global Head of Macro Strategy.
And I'm Michael Gapen, Morgan Stanley's Chief U.S. Economist.
Today, we're talking about the Federal Open Market Committee meeting underway and the path for rates from here. It's Tuesday, May 6th at 10 a.m. in New York. Mike, before we talk about your expectations for the FOMC meeting itself, I wanted to get your take on the U.S. economy heading into the meeting. How are you seeing things today? And in particular, how do you think what happened on April 2nd, so-called Liberation Day, affects the outlook?
Yeah, I think right now, Matt, I would say the economy is still on relatively solid footing. And by that, I mean the economy had been moderating. Yes, the first quarter GDP print was negative, but that was mainly because firms were front-loading a lot of inventories through imports. So imports were up over 40% at an annualized pace in the quarter. A lot of that went into inventories and into business spending. That was just a mechanical drag on activity. And the April employment report, I think, showed the same thing. We're now averaging about 145,000 jobs per month this year. That's down from about 170,000 per month in the second half of last year. So the hiring rate is slowing down, but no signs of a sudden stop, no signs in layoffs picking up. So I'd say the economy is on fairly solid footing, and the labor market is also on fairly solid footing as we enter the period now when we think tariffs will have a greater effect on the outlook. So you asked, Liberation Day, how does that affect the outlook? Right now, we'd say it puts a lot of uncertainty in front of us. It risks a sudden shock to the economy, and we risk a sudden stop in trade volume. So the economy is on pretty solid footing now. But Matt, looking forward, we have a lot of concerns about where things may go, and we expect activity to slow and inflation to rise.
That's great background, Mike, for what I want to ask you about next, which is, of course, the FOMC meeting this week. We won't get a new set of economic projections from the committee, but if we did, what do you think they would do with them? And how would you assess the reaction function one might be able to tease out of those economic projections?
You're right. We don't get a new set of projections, but New York Fed President John Williams did provide some indication about how he adjusted his forecast. And John tends to be one of the kind of a median participant. He tends to be centrist in his thinking and his projection. So I do think that gives us an indication of what the Fed is thinking. And he said he expects GDP growth to slow to somewhat below 1% in 2025. He expects inflation to rise to 3.5% to 4% this year. And he said the unemployment rate's likely to move between 4.5% and 5% over the next year. And those phrases are really key. That's the same thing, Matt, as we are expecting for the U.S. economy. And I do think the Fed is thinking of it the same way.
So one final question for you, Mike, in terms of this meeting itself. What are you expecting the Fed to deliver this week? And what are the risks you see around that expectation? What might catch investors off guard?
I think the Fed's main message this week will be that they're prepared to wait, that they think policy is in a good spot right now. They think inflation will be rising sharply, that the tariff shock is a lot larger than they had anticipated earlier this year. And they will need time to assess whether that inflation impulse is transitory or whether it creates more persistent inflation. So I think what they will say is we're in a good position to wait, and we need clarity on the outlook before we can act. In this case, we think acting means doing nothing, but acting could also mean cutting if the labor market weakens. So I think they'll be worried about inflation today, a weak labor market tomorrow. And so I think the risks around this meeting really are tilted in the direction of a more hawkish message than markets are expecting, at least vis-a-vis current pricing. I think the market wants to hear the Fed will be ready to support the economy. Of course, we think they will. But I think the Fed's also going to be worried about inflation pressures in the near term. So that, I think, might catch investors off guard. So, Matt, what I think might catch investors off guard may be a little misplaced. I'm an economist, after all. You're the strategist, you're the expert on the Treasury market and how investors may be perceiving events at the moment. So the Treasury market had quite the month since April 2nd. For a moment, U.S. Treasuries didn't act like the safe haven asset many have come to expect. What do you think happened?
So, Mike, you're absolutely right. Treasury yields initially fell, but then spent a healthy portion of the last month rising. And investors were caught off guard by what they saw happening in the Treasury market. I've seen this type of behavior in the Treasury market, which I've been watching now for 25 years. I've seen this happen twice before in my career. The first time was during the great financial crisis, and the second time I saw it was in March of 2020. So this being the third time, I don't know if it was the charm or if it was something else, but Treasury yields went up quite a bit. I think what investors were witnessing in the Treasury market is really a reflection of the degree of uncertainty and the breadth with which that uncertainty traversed the world. Both the great financial crisis and the initial stage of the pandemic in March of 2020 were events that were global in nature. They were in many ways systemic in nature, and they were events that most investors hadn't contemplated or seen in their lifetimes. And when this happens, I think investors tend to reduce risk in all of its forms until the dust settles. And one of those very important forms of risk in the fixed income markets is duration risk. So I think investors were paring back duration risk, which helped the U.S. Treasury market perform pretty poorly at one moment over the past month.
So, Matt, one aspect of market pricing that stands out to me is how rates markets are pricing 75 basis points of rate cuts this year. And just after April 2nd, the market had priced in about 100 basis points of cuts. How are you thinking about the market pricing today? Matt, as you know, it differs quite a bit from what we think will happen.
Yeah, this is where, understanding that market prices in the interest rate complex reflect the average outcome of a wide variety of scenarios, really every scenario that is conceivable in the minds of investors. And of course, as you mentioned, Mike, depending on exactly how this year ends up playing out, there could be a scenario in which the Federal Reserve has to lower rates much more aggressively than perhaps even markets are pricing today. So the market, being an average of a wide variety of outcomes, will find it really challenging to take out all of the rate cuts that are priced in today. Or said differently, the market will find it challenging to price in your baseline scenario. And ultimately, I think the way in which the market ends up truing up to your projections, Mike, is just with time. I think as we make our way through this year and the economic data come in line with your baseline projections, the market will eventually price out those rate cuts that you see in there today. But that's going to take time. It's going to take investors growing increasingly comfortable that we can avoid a recession, at least in perception this year, before, on your projections, we have a bit of a slower economy in 2026.
Well, it definitely does feel like a bimodal world where investor conviction is low. Matt, where do you have conviction in the rates market today?
So the way we've been thinking about this environment where we can avoid a recession this year, but maybe 2026, the risks rise a bit more. We think that that's the type of environment where the yield curve in the United States can steepen. And what that means practically is that yields on longer maturity bonds will go up relative to yields on shorter maturity bonds. So you get this steepening of the yield curve. And that is where we have the highest conviction in terms of what happens with the Treasury market this year. is we have a steeper yield curve by the time we get to December. Now, part of that steepening, we think, comes because as we approach 2026, where, Mike, you have the Fed beginning to lower rates in your baseline, the market will have to increasingly price with more conviction a lower policy rate from the Fed. But then at the same time, we probably will have an environment where Treasury supply will have to increase as a result of the fiscal policies that the government is discussing at the moment. And so you have this environment where yields on longer maturity securities are pressured higher relative to yields on shorter maturity treasuries. So with that, Mike, we'll wrap our conversation. Thanks so much for taking the time to talk.
It's been great speaking with you, Matt.
And thanks for listening. If you enjoy Thoughts on the Market, please leave us a review wherever you listen and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.